There's new skills to develop at household, the skills to develop as a professional as well. Because a lot of people, at least in my age group, we used to reading only printouts. Okay, now one fine day suddenly all the prints are gone. You don't even have the Finance Act with you. You don't have the new act with you. You're supposed to do everything on the computer screen. So that's kind of a difficult phase, but I'm sure people are getting used to it and are developing new skill sets. So with some of those opening remarks, I'll start, and before that, I want to thank Nilesh and IFA for giving this opportunity. That also gives me opportunity to to wear my office clothes after so many days. So that's also kind of a unique in that sense. So there are about
Radha, just a minute before you proceed and go into the technicalities. I will just like to repeat the instructions because many people have joined a bit late. So request to all the participants, please keep your video and audio on mute. By default, you have been kept on the mute mode, but if please do not unmute yourself. And any questions you want to address to the speaker, you can address in the chat box. Please note that the chat box is visible only to the host and the co-host and not to other participants. So please write only questions and not general discussion. Thank you. Radha, over to you again.
Okay, fine. So, this is broadly what I intend to cover today. Okay, I'm told that in fact I did attend a couple of this as well. That we already had a good discussion on Section 6 as well as on equalization levy. So I placed those two items at the bottom. Okay, so the idea is that I'll spend lesser time on those issues, and we'll try to do more justice to other issues because those issues are already discussed. So I'll be discussing amendment to Section 9, which is around attribution and how it gets, issue gets addressed through APAs and safe harbor rules. I'll be discussing amendment to Section 90, 1023 FE, that's a new provision which comes in. We'll take a broad overview about the digital economy, Indian approach to digital economy. There are amendment to Section 9, especially I'll be looking at explanation 3A. And then, at the end of it, if you have some time, I requested the coordinators to pass on only very simple and basic questions to me, so which I'll attempt to address. So with that, let's start with the first topic. Okay, and the first topic is amendment to Section 9 around attribution of profits to PE. Now, before we understand the amendment and how they intend to do it through APA route, let's understand, the basic structure of the Act and how the issue of attribution has been addressed, all these years. So our basic provisions are, we have Section 5, Section 911, which talks about chargeability. And then you have Section 145, which says the method of accounting, so the profit which you generate as the method of accounting is something which is subjected to tax. And then this is, this acts as a kind of a default rule. Okay, to begin with, you're supposed to determine your income as per this rule. And then you have Rule 10, which is not a default rule. And this rule is to be applied, when the first method fails, or maybe, when it's not possible to determine income, or the officer is not satisfied as per, what the assessee has done. Then he can invoke Rule 10. And within Rule 10, there are three methods. One is percentage of turnover, what AO feels reasonable, as a measure for determining profit attributable to operations in India. You have a proportionate method. And the third method is, kind of gives absolute discretion to the officer, which is any other method which he may deem suitable. And then you have Section 44B, 44BB, 44BB, and that entire series, which is kind of, presumptive taxation. And it presumes certain percentage of your income to be subject to tax in India. Now, let me explain the remark column, which is the third column. And then if you see the first two, I'm saying absence of statutory guidance on quantum of attribution. And what do I mean by that? And in the third row, I'm saying there is a presence of statutory guidance on quantum of attribution. So the main issue of attribution of profits, to my mind, is like this. In a situation where there's a cross-border transaction and certain functions of the profit of the business are performed outside India, certain functions are performed in India, Okay, and let's say that the profits made is 100, and the question is, how do you distribute this 100 of profit between two countries? You have some functions performed in country A, you have some functions performed in country B. How do you distribute? And that's where I feel that there should be a statutory guidance on this. The law should provide that these are the functions performed in a country, India, then this is the profit which will be taxed, and that guidance is missing in section 5, section 9, section 145, even in rule 10. And this has been a position, I would say, for almost 100 plus years. I mean, even if I go to 1922 act, okay, there's no statutory guidance. And I feel when this law is determined about attribution, that's essentially a sovereign right of a country. So I don't see anything wrong if a country says that if you are carrying on this many functions in India, and then this will be the profit attributable to that profit to the function in India. When we look at section 44B, presumptive taxation, to some extent, that statutory guidance is there, because that's where the law tells you that this is the proportion by which you get tax in India. So this has been, the current approach, so to say. And what has that approach resulted in? Okay, that approach has resulted in a huge amount of litigation. Okay, and the courts have gone to the extent of saying that this is nothing but a guesswork. Now this is this is a slide which I've been using for last 15 years. Okay, but that's that's the fact of the matter, is that the judicial authorities have said that attribution of profit is nothing but but a guesswork. And higher up you go, the authority would typically say that we do not want to further get involved in this. And when you look at the observations of the Supreme Court in Hukum Chand, it categorically makes a reference to absence of statutory or other fixed formula. Okay, so what we're talking now is something which the court noticed in 1976. So in absence of statutory guidance on how to attribute profit, you had a huge amount of litigation, and then that certainly resulted in a lot of disputes. Now let's look at what is the new approach coming up. You have a new rule coming up, which is Rule 10, which the government has kind of released in a draft form, and maybe it will become a reality at some point of time, that adopts a kind of a formulary approach, giving equal weightage to assets, labor, and markets, the demand side of it. It is still not made a default rule. Okay, it is still appearing as an alternative. But it has some sort of statutory guidance about quantum of attribution. That's what I described. We have two set of rules waiting. They are probably in the making somewhere. This finance bill, this finance act amended section 295 2B, and subclause 2A and 2B are the ones which would which will authorize the government to come up with some more rules. So we have some more rules which are likely to come up, and we still don't know whether they are going to be a default rule or a not default rule, and what kind of statutory guidance the rules will have. And then finally, you have for the first time attempt is made to take up this issue of attribution in APA or safe harbor rules. Again, this is not a default rule, okay, but this is it happens at the option of the SSE. And this is where the SSE and the tax officer will sit on the table and agree on the amount of attribution. Now the issue is, because APA and safe harbor, are a part of a transfer pricing regime, so to say. The issue is, can the issue of attribution of profits to operations in India be addressed by transfer pricing provisions or transfer pricing provisions alone? There are two questions in that sense. Well, I may keep on disputing a lot of with my transfer pricing colleagues, but my answer is that clearly no. Transfer pricing gets involved only when there's a transaction between related parties. In cases other than that, how much profit to be attributed to functions performed in India, okay, that's where the government, that's the statutory right which the government has to exercise and give a clear categorical guidance. So TP as such, alone cannot resolve this issue. Let's look at the amendment they have made. They amended section 92CC, which deals with APA, and it makes a reference that the new provision which has come in is clause B, And then if you see the pattern or the manner of this amendment, which is also suggesting that they've not made a reference to arm's length price, for section 911, but they have categorically linked section 92cc with 911. It says income referred to in clause 1 of subsection 1 of section 1 is to be determined as per this method. So the manner in which these amendments are done in section 92cc as well as 92cb, also kind of suggests that acceptance of a theory that attribution is not something which is to be determined exclusively based on transfer pricing rules. Transfer pricing rules is going to be addressing a part of the issue of attribution. Now, effectively, what happens, and before that, let's look at some of the observations, some of the issues which arise on this aspect. When we look at the explanatory memorandum, okay, the memorandum is using the word attribution of profits to PE. Okay, and then the question which comes up is that, well, in the domestic law, section 911, it doesn't make a reference to PE, and does the explanatory memorandum in some sense restrict the scope of the provision? The question being, because the memorandum makes a reference only to PE, can this rule be applied only in a situation where the PE exists? To my mind, the question is no. The explanatory memorandum need not be referred to, in this context, because the provisions of the law, amended sections are very clear. So the one particular sentence in the explanatory memorandum is not likely to restrict the scope of this provision. And next question, does the Finance Act adopt a transfer pricing as a solution to the problem of attribution? Again, I would say answer is no, because the issue is not necessarily getting determined as per the transfer pricing methods. It's not a determination of arm's length price, but what gets adopted is probably a transfer pricing framework. Okay, transfer pricing certainly has a superior method to determine, profits, attribution of profits to certain functions, and they have a framework to determine this issue. The framework, when I say framework, it's a framework of APA, it's a framework of safe harbor rules. So what gets done here is that that framework gets adopted for the purpose of determination of profit attributable to the certain functions performed in India. So, that's a manner in which this issue is getting addressed. Does the proposed approach create any conflict with the tax treaties? Again, I would say it does not create a conflict. When I look at the tax treaties, if the non-resident has a PE in India in the source country, the source country gets a right to tax the profits which are attributable to that PE. And how to quantify this profits attributable to the PE are to be determined purely on the basis of the domestic law provisions. Okay, so in that sense, I don't see even there to be a conflict with treaty provisions. The treaty provisions, Article 7, can be said to have element of untranspressing provisions. It certainly has, and to that extent, those obligations of arm's length, would get honored in the domestic law as well. But beyond that, the provision as such does not, violate, anything in the tax treaty. So, to sum up, I would say this is, clearly a welcome move. Okay, for about 100 plus years, we did not have clear answer. We have started, government realizing that, they need to give a specific answer to these questions. So, something which the Supreme Court observed in 1976 about a specific formula is now, gradually coming in. We saw something coming in draft rule 10, and that will come out, in some form. When we look at globally what's happening, even globally, when we look at this pillar 1 and pillar 2, especially pillar 1, that's also going to a particular formula. So that's also kind of not completely ignoring transfer pricing, but it does recognize that a different mechanism is required to determine the issue of attribution of profits. So on the whole, we are kind of moving from a complete arbitrariness to a situation where there would be an agreement between the parties, and obviously the success of this will depend on how would the parties how the authorities would react to this. Otherwise, if we look at the judicial precedents, we'll find a number of precedents where the assessing officer says that, well, 80% of the gross receipts is something which is subject to tax in India. When you go to commissioner appeals, he'll say, no, it should be 60%. When that goes through tribunal, it says, tribunal says, no, it should be 25%. So, the numbers keep on changing, based on the arbitrary, kind of judgments, and they do accept that this arbitrary judgments. So, it depends in this APO processes, to what extent, the reasonable stands, taken by both the parties, and that's going to determine, the success of this measure. So that completes, the discussion on the first point. Then I'll move on to amendment to section 90. Now, this amendment is, it's very interesting, and I kept on wondering, for a very long period of time, what is this amendment doing exactly here? So, as a part of BEPS measure, Article 6 of MLI, effectively amends the preamble of all the tax treaties, providing that the treaties are not there to create treaty shopping opportunities, or opportunities for non-taxation or reduced taxation, and that's how this language is supposed to form part of all the tax treaties preamble now. What they've done is that they have picked up that language and inserted that language in section 90, subsection 1, clause B. Now, as you all know, what does section 90 do? It essentially gives a kind of a power to the government for entering into a tax treaty, and it lists down A, B, C, D, the purposes for which a tax treaty can be entered into by the government of India. So they have kind of sort of tagged this sentence from MLI to section 91 B. And then when we look at the explanatory memorandum, so they have narrated, the provision of MLI in the memorandum, and then the subsequent para says that in order to achieve this, so in order to achieve the, the MLI objective, it is required to contain the tax provided in MLI as mentioned above. So, the explanatory memorandum is suggesting that to give effect to MLI, it was essential to include this text in the domestic law as well. Now, I mean, frankly, I have not understood, or maybe I'm in disagreement, with this kind of a theory. I'm yet to, check with, some of my colleagues in other countries, whether globally what other countries have been doing on this, whether have they amended, their domestic law to include this language. But on the face of it, I don't see that there is really a need to amend the domestic law for this purpose, because if section 90 permitted government of India to do A, B, C, D, okay, then government of India can certainly do A and B. There's no, if even if C and D is not required, government has a power to do it. So within the existing powers, within the powers as they as they were there before the amendment, the government could have easily achieved this objective of ensuring that there's no opportunity for non-taxation, and within the power itself they would have entered the new treaties. Now, having concluding that this was probably not required, it is still necessary to understand what does it do. Now we have this provision in our domestic law. What is it doing? Now, to begin with, on the face of it, it's very obvious that this provision is essentially curtailing the powers of the central government. So let's go back. The provision as it read before the amendment, said that for the purpose of a treaty can be entered into for the purpose of avoidance of double taxation on income, under the domestic law and the corresponding law in force in the other country. And now there is an additional condition attached to it, says that, well, when you do it, you have to ensure that you don't create an opportunity to avoid double non-taxation. So I read this provision, to mean that this is essentially a curtailment on the power, of the rights of the central government to enter into a tax treaty. They have an obligation to ensure that when they enter into new tax treaties, they have to keep this in mind. Now let's understand what is the impact of this on the tax treaties. Existing tax treaties, obviously there's no impact of this change. The treaties were entered into, when under a power which prevailed under a different section or a different provision of section 90. Okay, so when the treaties were entered into, they were well within the power of the government when they entered into. is going to have an impact on the future tax treaties. And how it's going to impact the future tax treaties? The interpretation of the future tax treaties, would get impacted as a result of this. So whenever the issue of interpretation comes, well, it's not only the MLA, it's not only the preamble of the section which will also be quoted, but but one will also say that the government always had a power to enter into a treaty which is not necessarily creating a treaty shopping kind of a scenario. Now, very interestingly, if we go through some of the paragraphs, some of the issues which were discussed in Azadi Bachao Andolan, in Azadi Bachao, one of the issues which were raised is that the government did not have power to enter into a treaty, with Mauritius, given the kind of consequences it created. And then the Supreme Court has, analyzed the text of Section 90 and come to a conclusion that yes, it was very much within the power of the government to enter into this kind of a provision, this kind of a tax treaty. So there's no ultra vires, thing which is happening. But with this new language, with this additional text in Section 91 subsection 2, I'm not sure in the future, something like this goes to the court. I'm not sure how the court is going to look at the matter. With that, you have a lot of new terms, which are entering in the domestic law for the first time. We all are familiar with the word treaty shopping. It's kind of getting used very commonly, but it gets utilized in the law for the first time. Okay, and obviously, there's no corresponding definition which has come in. And then there are other views, which are other words which have come in the domestic law: non-taxation, reduced taxation, indirect benefit. So these are the words, which will come up, for litigation, for interpretation in the future. We'll have to frame our thoughts on how do we interpret these words. Although most of us, have been using these words, most of us have an understanding of this word, but obviously when it forms part of the law, okay, it kind of attains a different level of seriousness, because then the law requires you to come up with a solution or interpretation of these terms. Now, these terms, before it enters the domestic law, they are already there in the tax treaty, by virtue of MLI. And when one has to, implement MLI, when one has to interpret the tax treaties, one will have to refer to Article 3.2, which says that when a term is used in the treaty but not defined, you go to the domestic law. Certainly, these terms, treaty shopping, non-taxation, reduced taxation, indirect benefit, these words are not defined in a tax treaty. The OECD material certainly gives good guidance on this. OECD commentary also gives good guidance on this. BEPS material gives guidance on this. But the fact is that these terms are not defined in a tax treaty. And then we have a section, subsection 3 in Section 90. Which authorizes the government, to define a term which is not defined in a tax treaty. So, it will not be, we should not be surprised, if the government comes up, with a definition of these terms, either in domestic law itself, or exercises a power under subsection 3 to come up with the meaning of these terms. So, I would say a very interesting amendment to make. Especially something which, especially for the reason that this was not contemplated, but at least by me and the professional colleagues with whom which I checked, the prima facie views that this was probably not required. But once it is done, it has certain implications. It does, result in certain consequences. So I just reproduced the the relevant extract of the Supreme Court judgment. The presentation, would be shared with you, so maybe in the future you may want to refer to it. Well, so with that, that kind of completes the second amendment which I wanted to cover today. And with that, I'll go to the third one. Before I go to the third one, Nilesh, am I going right? Is it too fast, too slow? Any feedback you have to give it to me?
No, I think you are doing just fine. And I don't think there are any questions on this topic as of now, because no questions have come up. So people will, maybe when we open up the questions at the end, you will get questions. And I think you are doing fine.
Okay, thanks, Nilesh. So I'll kind of continue the same uh, speed and tone.
Yeah.
Well, the next amendment is not as an amendment; it's a new provision which comes in. It's section 2023 FE, and it basically exempts income in the nature of interest, dividend, and long-term capital gains earned by specified persons from certain sectors in India. And then everything gets defined in the provision, but there are certain interesting aspects which are up for understanding, and it will be good to look at some of them. So the first category of specified person is wholly owned subsidiary of ADIA, which is Abu Dhabi Investment Authority. And so basically this is a kind of a specific benefit given to a specific taxpayer of another country, and the benefit is given when they make investment directly indirectly out of the funds owned by the government of UAE. So this is a very specific, and probably not much of the issues which come up from this part of the provision. The next two part, the second specified person is a sovereign wealth fund, and there are conditions which are attached to sovereign wealth fund. And the conditions I'll just refer to very briefly, and in the subsequent slides we have some more things to discuss on these conditions. The sovereign wealth fund should be something a fund which is directly, indirectly owned and controlled by the government of a foreign country. It should be set up and registered under the laws of that particular foreign country. On dissolution, the assets of the fund should vest with the government of the foreign country, the foreign government. It does not undertake any commercial activities, and this issue will require a good amount of understanding. And the earnings of the fund accrues only to the government and not to any other private person. And then having given this specified conditions, the last thing which says that only those sovereign wealth funds which are notified by the Indian government are the ones who can get this benefit. So the fund has to satisfy all these conditions, and then the government it should also kind of obtain maybe some kind of approval from the government. Only thereafter government will notify the fund, and then they get the benefit. And then the third category which got inserted as per the Finance number 2 Act, as suggested by Nilesh, because that was equivalent huge amount of changes which happened there, which is a pension fund. The conditions related to pension funds are probably they are yet to evolve. The basic ones are given in the Act. It said it should be established in the law of a foreign country, or its political subdivision, or a state, or a province, by whatever name called. It's not liable to tax in a foreign country, and it satisfies other conditions as may prescribe. So this I would say is probably a window which is kept open by the government to kind of put in all the conditions which they want to bring in. And obviously after all this, the fund still needs to be notified by the Indian government. So these are the conditions around the specified person. And then you have certain other conditions which all the funds or all the specified persons are supposed to satisfy to avail the benefit. Now, one such condition is that investment is made during a particular period, which is after 1st of April 2020 and before 24. Now, interestingly, when this provision came for the first time in the finance bill on 1st of February, the opening date was not there. 1st April 2020 was not given, and before the only end date was given. And that created a lot of questions. Whether the pre-existing investments would get the benefit or not. Okay, but now they have kind of specifically addressed this issue, and that essentially means is that it's the benefit is given only to the fresh investments or the new investments which will be made after 1st of April 2020. Investment is held for at least for a period of 3 years. That's the second condition, and there are certain issues which are rising from this 3 years condition, which we'll discuss in the subsequent slide. And then investment is is in a specified sector, and it's predominantly this is all around infrastructure sector. Well, on the top of it, the government has a right to notify other sectors. So other business sectors may get opened up for this purpose. So now, with this basic understanding of these provisions, let's look at some of the other aspects of this. Now, the concept of sovereign wealth fund, comes into the law for the first time. Okay, yet this term is not defined. Okay, if you read the section 1023 FE categorically, the term SWF is not defined. The conditions with SWF needs to satisfy are given. Okay, so that means we still have to understand, what is the concept of sovereign wealth fund and what is the meaning of this term. We have some meaning, which is emerging, which is given in OECD commentary. So it's very easy to make a reference to this. So, these are essentially government-owned fund. Okay, the governments of the world, of different countries generate income from various sources. They have the internal sources, they have external sources, and then these funds are utilized, for a special purpose, investments. Okay, so these funds are utilized for government investments, in so to say, and these are the funds which are kind of created by the income which accrues to government over a period of time. So this is essentially a concept of a sovereign wealth fund. Obviously, I mean, last 50-20 years, a lot has happened around this sovereign wealth funds. The volumes of investments of sovereign wealth funds have been increasing, and and then now we have seen the impact in the domestic law itself. Now, from understanding the law, and especially from academic perspective, when we look at the conditions, which are to be satisfied by the sovereign wealth funds, one gets a flavor of, giving benefit, on the basis of principles of sovereign immunity. Now, sovereign immunity is essentially a principle which is there in the customary international tax law. In a nutshell, this principle says that one sovereign cannot tax another sovereign. One sovereign cannot sue another sovereign. One sovereign cannot proceed another sovereign. So these are basically the principles of international law, around sovereign immunity. I mean, of course, we have, in the recent past, and we have seen a lot of things happening around, at the political level in this principle. But, this principle is important from tax perspective as well. Now, now going by this principle, if one country or one government of one country earns income from another country, okay, the other country, the source country, cannot levy tax on this. That's, that's the broad level principle says. Having said that, there is no international consensus, on this principle. It's not only the OECD commentary, kind of takes cognizance of this, absence of consensus, but even the Indian judiciary, has been taking a note of this. So what is the exception to this? The exception to this is that, when the government earns income from a commercial activities, okay, when a government earns the income from something, from functions which are not necessarily a government function, which are not state functions, the government gets involved in business, flying aircrafts, running telecoms, whatever. These are not essentially government functions. In those cases, the source country did not necessarily respect the principle of sovereign immunity. So the principle, as such, has diluted over a period of time. Okay, that's for the reason that that the governments have been across the world, have been doing different activities, have expanding the scope of their activities, to include various commercial functions as well. And in response to that, the principle has kind of started diluting and is applied differently. So let's look at how did the Indian judiciary react to it. I mean, the first principle which I have noted around this is that of Iraqi Airways. Essentially, Iraqi Airways, was a kind of a department or a division of the government of Iraq, which was running commercial flights. And then, the issue which arose in India was that, does it generate income which is subject to tax in India? Can this income be taxed? The tribunal, clearly respected the principle of sovereign immunity, and said that, well, the Iraqi Airways is entitled to obtain the benefit of sovereign immunity, and its income cannot be taxed in India unless there is something specific in the Indian law which permits taxation of such sovereigns. 20 years later, Delhi bench, special bench, took exactly contrary view. The Delhi bench, special bench said is that uh, you know the foreign airlines owned by another government can be taxed in India unless and until there is a specific can be taxed in India only if there's a specific provision to that impact in the Indian law. So it took exactly contrary view, okay, and essentially said that you are entitled to sovereign immunity only if the Indian law, Indian tax law, categorically recognizes that kind of immunity. I see that as a sort of background for a lot of the conditions which are attached to this sovereign wealth fund. And I'll just bring back this slide for a moment so that you can now look at these conditions and then you can kind of get a sense that yeah, all this is happening to the structure is around the sovereign immunity, and based on that they have created this exemption. Now, having understood that, as against giving exemption on the basis of sovereign immunity, okay, they have made out a clear law. The question which comes up is that if for some reason in the benefit of 1023 FE is not available, or if the fund earns income which is not categorically mentioned in 2023 FE, whether the benefit will be available or not, I would say the answer will be clearly no, because this investments by virtue of these provisions can be said to be understood as not a state function. Okay, so the sovereign immunity principle does not apply, and the government of India is going to levy tax on that income. With that, let's look at some of the more issues related to this. One of the condition is that the earnings of SWF is credited directly to the account of the government, and no private person can get a benefit of it. Now, the SWF kind of permits, as I said, direct indirect holding of the foreign government. And then the question is, the income will in that sense will indirectly flow through the foreign government. And then again, the question will be that, can the foreign fund, can the SWF, have borrowed money if the fund pays interest to a third party? First of all, whether the regulations of that country would permit such kind of a borrowing, that's that's a different question mark altogether. But presuming that that kind of thing is possible, whether that borrowing or interest payment on that, which is not going to government, be seen as a violation of this condition. When the fund incurs various expenses, some private person be said to be benefiting out of it? I would say the answer is no. But depending on the facts of the case, some of these issues will come up. There's another angle to look at, commercial activities. For the moment, let's presume that there's no concept of sovereign immunity. But by plain vanilla understanding of commercial activity, would not investment activity itself qualify as a commercial activity? So, when a fund makes investment, in various opportunities, in various entities, that itself may be viewed as a commercial activity. Okay, if that kind of interpretation is taken, okay, then kind of the section would never take off. Okay, so one will have to interpret the words differently, or take a different interpretation in the context of section 23 FP. Okay. Now, internationally, there are various issues, which are raised due to investments or the increased investments by sovereign wealth funds, and these issues are, can easily be searched, on a Google. The governments are essentially concerned about, the interference of the foreign countries, in their domestic affairs, okay, by virtue of this SWF, because the volumes of investments are increasing. Just about a couple of weeks back, we saw the Australian government amending the laws, to prevent the Chinese, taking over some of the Australian assets, as distressed assets. So, the activities of SWS, have clearly raised kind of concerns, across the world, on several aspects. And that could be the reason, to address those concerns, one can presume that when the government decides to permit, by a specific notification, it can be presumed that, when the government has to permit some, some fund, by virtue of a specific notification, they are going to, address these concerns. They will be going to be careful about these aspects, when they permit SWF. Again, over a period of last 15-20 years, the importance is increased, and some sort of framework or some sort of guidelines or good practices, has evolved around this sovereign wealth funds. So, something called Sandiego principles, and there are 24 guidelines, which are, which they are supposed to follow. Okay, so now with that, let's move on to the pension fund. The biggest question which comes up here is that would the benefit be available to the private pension funds? The pension funds, could be run by government, could be run by a private corporate for its own, or could be run by insurance companies. So there are various kind of pension funds, and obviously the private pension funds would want to open to the opportunities of investments and tax exemptions. The first issue which is going to come up is that are they entitled to the tax incentive? Now, considering the basket in which they are placed, the basket of specified person, you have Abu Dhabi Investment Authority, you have sovereign wealth funds, and the pension funds are placed in that basket. That gives a flavor that they're likely to give benefit only to the government funds and not to the private funds. We looked at the definition. The definition clearly made a reference to local authorities, state, provinces, and that means that some countries wherein the government pension funds are run not only by the central government in a federal structure, but also by state governments or local bodies. So even those local body or state government pension funds, may be eligible for this benefit. Yeah, and then these conditions, probably I don't want to repeat. These are the same repetitive things, but then again, the government is going to permit each of this one by one, because the government has to make a notification about their eligibility to claim the benefit. Only after that they qualify. Of late, we have seen a lot of changes in the OECD model itself around pension funds. Okay, we have a definition of recognized pension fund coming for the first time. They're getting recognized as a resident in Article 4, and we have Article 29, which is also taking that as a qualified person. So, a lot more is developing around pension funds, internationally as well as in the OECD model. A couple of issues, other issues, and a very interesting issue which comes up because of the condition of a minimum 3 years of holding. So we have one condition is that long-term investment or long-term capital gains are exempted, and then the long-term another condition is that it should be held for a minimum period of 3 years. Now, when you look at the condition for long-term capital gains, the period of holding is not necessarily 3 years for all the assets. For somebody it's 12 months, somebody it's 24 months as well. Now, what it means is that in addition to get qualification of a long-term capital gains, there is an additional condition that asset must be held for a minimum period of 3 years, before it's sold to claim that benefit. Now, this issue gets a little more complicated when it comes to claiming interest and dividend exemption. The question which comes up is that what happens on the interest or dividend earned by the fund in the initial period of 3 years. It's not possible to satisfy the condition of 3 years holding in the initial period of 3 years. Okay, so at what stage the benefit should be available? One approach or one interpretation could be that for first 3 years, you don't get an exemption. You get an exemption only after you satisfy the condition, which is in the 4th year you get an exemption. Again, I mean, that doesn't seem to be a very good interpretation or a very good approach. But before this gets far more complicated, when the second round of changes happen in the Finance Act, they have inserted one more proviso, which says that when when exemption is claimed, but subsequently the fund does not satisfy the condition, okay, the exemption kind of gets withdrawn and the income is subject to tax in the subsequent year in which the condition is not satisfied. So, this essentially gives an kind of, gives an implication that the provision section contemplates that the exemption would be given, okay, in anticipation of a future compliance by the fund. And if we take that kind of interpretation, the benefit of interest and dividend should be available in the first 2-3 years as well. The investment is permitted in a company, enterprise, or an entity. Okay, company investments, are very clear. What is enterprise? Would be up for discussion and debate and probably disputes as well. Again, what is entity? Would also come for issues, and more issues will come up. Let's say there's investments, in an enterprise or an entity like an LLP. Okay, what can be said to be dividend? When this enterprise or an entity distributes profits. So we have this kind of issues which are likely to come up. So with that, I kind of finished the third issue, and then let me move on to the next issue, which is Indian approach to digital economy. So broadly, I tried to tabulate what are the things happening in India. We started in 2016, with equalization levy on online advertisement. It was at the rate of 6%, and then in 2018, we got the concept of significant economic presence. Okay, that never got kind of activated or operationalized, and the implementation has again been deferred. In 2020, we brought in explanation 3A, and this is something which we are going to kind of discuss in far more detail, which is going to levy tax at the rate of 40% full rate on certain categories of income. Thereafter, subsequently, when I say subsequently, means after 1st of February on 23rd of March, another concept comes in, which is equalization levy on online sale of goods and provision of services, wherein EL is charged at the rate of 2%. So, all this is happening on the direct tax side, targeting a non-resident. On a domestic side, targeting a resident, is we have section 194O, which is a TDS provision, again on e-commerce operator. And then we have, things parallelly happening on indirect tax front as well. We have section 52 of CGST Act, which is, TCS on e-commerce operator. And then we have a concept of, OIDAR, online information and database access and retrieval services, which is there in GST law. These provisions are there since 2017. Probably they were there in service tax law itself. I mean, I've not tracked service tax law enough, but they are certainly there in GST law. So, this is all what, India has been doing parallelly on this. And if you, try to draw a picture, okay, it appears like this. Okay, it creates many circles, and, and what overlaps what, okay, which circle overlaps which circle, or which provision overlaps which circle, becomes, sort of difficult. So one has to kind of navigate through this maze and find out what is the correct solution. Now, it's obvious that while India has brought in all this, it's not that everything gets implemented, at the same time. The strategy is very clear. The government is participating clearly in OECD work on webs and digital. And what they are doing is that they are parallelly, creating provisions in the domestic law. Because when the treaty gets amended, when the rights are given under tax treaties, or whatever the mechanism, which is kind of agreed in the inclusive framework through a consensus, okay, our domestic law is ready, to levy tax on this aspects as well. So some of the circles, would not be there, would not be required, or may never get implemented, unless there is actually no consensus. For a very long period of time. Some of the circles, kind of address each other, especially that, if something is getting taxed on equalization levy, okay, then there's no tax on the same item in the Income Tax Act. So, with that, let's spend some time on explanation 3A now, okay. So we are going to, kind of spend some time on this, in this measures, in a greater detail. Well, before I go that, let me make a couple of comments, I would say, I mean, I have a, I have a clear feeling that when we look at the circle, uh, we have provisions of Section 5, which are probably very broad and very wide, and it will come up in subsequent slides. And maybe if we strictly interpret those or apply those, then I'm not sure whether there was a need to go on creating new circles, more circles and more taxing rights or more provisions. Okay, but Section 5, to my mind, clearly gives a lot of right to the government to levy tax. But I mean, be it as it may, we know that some of this is kind of a temporary measure, which is the officials have clearly said that some of this is temporary measure, may not get activated. Okay, and some of this is clearly done in a unilateral manner. Okay, so with that, let's go to explanation 3. And then before we start with the technical position, okay, let's look at what is said in the in the explanatory memorandum. So the explanatory memorandum kind of clubs few provisions together, and what appears in the bold is kind of heading to the provision. It says, and these provisions are explained together. And I find this paragraph to be very interesting. It says, further, as per the discussion going on in the international forum, the countries generally agreed that this kind of income needs to be accounted for in Indian revenue. So frankly, I'm not able to contemplate any discussion when the countries would gather together and say yes, we agree that this income should be subjected to tax in India. So that may not be the case, and maybe that may not be the context of the intention behind writing this. But what they convey is that that probably this provision kind of comes in as a result of the recent discussions in the international forum. International forum, I think we can easily relate that it's a BEPS inclusive framework discussion. What's happening around that? So if we have to interpret and understand these provisions, clearly we can rely and go back to the discussion which are happening in the inclusive framework and the OECD material. And then in 2018, when we look at the interim report of digital, their OECD first says that the country should not come up with unilateral measures. They probably will write few paragraph negating that one should not do. But then at the end of it, they'll give 3 pages saying that if you do it, then this is the broad framework within which you can do. So we can also compare explanation 3A with what framework, with what broad guidance OECD has given. Obviously, it's not possible to do it in this session, but certainly it's possible to do it. So one can create a comparison. Now, this is a very interesting provision. The manner in which this is written, and this is new explanation 3A. Part of it is kind of reproduced in the middle of the page, and it says, for the removal of doubt, it is hereby declared that the income attributable to the operations carried out in India, as referred to in explanation 1, shall be include income from. Now, what exactly does it mean? What are they trying to do? What does this explanation mean? What is thought to be achieved? You have section 911, which says that income from business connection in India, income asset in India, source of income in India, transfer of property in India is subject to tax in India. You have thereafter you have explanation 1, which makes a reference to operations in India, and it says that your profits attributable are the ones which are reasonably attributable to operations carried out in India. And then you have this expression 3 which comes in, which kind of says that it removes doubts and declares that income attributable to the operation carried out in India shall include income from advertisement income. So what does it do? To my mind, I read this as creating a dimming fiction, and the fiction essentially includes this category of income, which is sale of advertisement data and the products based on this data, as income from operations carried out in India. So the dimming fiction is that when a non-resident earns income from sale of advertisement, when earns income from sale of data, that income is to be deemed as income from operations carried out in India. So that, that's kind of a dimming fiction which this provision creates. I mean that's a literal reading of this provision, which I'm able to settle maybe 2 months after the provisions are announced. And then the question is, in absence of this, was there a right to tax? Why is that? Someone has to deem something to be income arising or income attributable to the operations carried out in India. And then we may want to go back to 1953. There is a Supreme Court order, which is a very strong observations, around operations in India. And then, this words, I mean, obviously this is on a 1922 Act, but the provisions, were comparable. The Supreme Court, essentially says that it's not each and every business activity, which comes within the expression operations, to which 42.3, which is essentially 911 today, are attracted. So there is kind of a written, unwritten, notional accepted business notion, about operations. What could we say to be business operations? And essentially, what is saying that only if this kind of operations are performed in India, okay, only then the India gets a right to tax the income. So essentially, what I see this as doing is that, well, maybe there's a doubt that what happens in India may not be treated as operations at all. Okay, and then because of that, there may not be any income which can be attributable to those operations or to those activities. Because unless there's an operation in India, unless there's a recognized operation in India, unless there's an operation which is in an accepted business notion and usage, is stated as something on which profit should be attributable, the income cannot be taxed in India. So in this activities, in this kind of income, what operations are performed in India? When advertisement is targeted, at a user in India, okay, the Indian user, and I'm using the word Indian user, is viewing the advertisement in India. So the operation of viewing the advertisement happens in India. The operation of accessing the advertisement happens in India. The operation of data collection happens in India, in the other two categories related to sale of data. So, one way of interpreting this is that, probably based on the Supreme Court judgment in Anglo-French, maybe there were some doubts, which said that this functions or this operations may not be seen as, operations to which profit should be attributable. And, and the government is now trying to, address this issue by creating a dimming fiction. And I'll bring back this slide, and I'll take a pause here for a moment. So, so that this can sink in and, people can handle this. So, you may just want to read the explanation once again and understand what it is saying. Well, something which I kind of forgot saying, in my opening remarks, is that something which I say in this presentation, is very well understood, clearly understood, and the concepts are clear. But a lot of it, may merely display, my individual struggle to understand these provisions. And some of the slides, essentially are doing that. They are indicating my struggle to understand these provisions. And maybe, I may end up confusing people more on this. Well, with that, I'll move on to the next slide. And, it takes me to a very interesting, and I would say one of my favorite judgments of Supreme Court, which is Performing Rights Society Limited. I mean, I would say, this is kind of, a kind of a master slide, or, or a master, judgment, which keeps on guiding, which kind of keeps, works as a benchmark, or as a notepad to understand, how the provision should be interpreted. So in this case, Performing Rights Society, a UK-based entity, had entered into agreement with All India Radio, and by virtue of that agreement, All India Radio was permitted to broadcast live music or music belonging to the society in India. So I'm just presuming that there would be some arrangement, the way these companies may have with this the FM channels, when the channels would have right to play the music in India. So the same thing must be happening in 70s as well. So All India Radio had played this music in India, and it was obliged to make a royalty payment to the society for broadcasting this music to India. The society, the UK entity, tried to claim that this income is not taxable in India. Okay, all the functions happened outside India, and the court said nothing doing. The income accrues in India. The court said this is a common sense approach. The music is effectively consumed in India. The music is effectively relayed in India. The person who is enjoying the music is in India, and then there's no doubt that the income accrues in India. And the court goes on to say that income accrues in India in Section 5 itself. So Section 5 has two parts: accrues in India, accrues or arise in India, or deemed to accrue and arise in India. And obviously the third part, received in India. But the court says that this gets covered in the accrual part itself. Now there's no need to go to the dimming provision. So there's no need to get confused with Section 911. And obviously in those days, in 77. So 77 is the year in which the judgment came. So it must be at least 15, 20 years before that. Section 916 and 7, did not like this. So the point here is that when we look at this advertisement, viewership of advertisement in India, or data collection activities in India, how different they are, from a situation which was addressed, way back, 50 years back, by a Supreme Court in Performing Test Society. So explanation 5, not explanation, Section 5, to my mind is very broad, has a lot of rights to the government to tax income. But what has happened over a period of time is that to make things simpler, to avoid litigation, the dimming fictions or dimming provisions, we kept on added dimming provisions. And it has happened that over a period of time, people probably forget to look at the powers under the main section, and the assessment, or even the professionals may be advising only looking at the dimming fiction, without even analyzing whether income is accruing or rising in India under the Section 5 itself. So with that, now let's go back to explanation 3A. So as I said earlier, explanation 3A is essentially creating a dimming fiction as to certain operations, certain income is to be seen as arising from certain operations performed in India. Now, the question is, does it need a business connection? The obvious answer is a yes. Explanation 3 can be invoked only if there's a business connection. Okay, so only it has to kind of pass all the tests. Only if there's a business connection, there's a explanation 3A gets involved. So there's there's little doubt on that, but the way this explanation get added, we have to keep on reminding us this explanation has to satisfy the business connection requirement as well. Can there be an overlap between explanation 2A and 3A? That's a very interesting question, and the answer is still theoretical. To my mind, it's not necessarily the final answer, but this is this is the way the current thinking is for me. And on the advertisement part of it, when we look at explanation 2A, okay, it's targeting it's basically the SCP, especially economic presence provisions. It's targeting income on account of systematic and continuous solicitation of business, the income which is generated by virtue of these activities. And when we look at the explanation 3A, it's targeting the advertisement income. So my prima facie view is that the people who are earning this income are would be a different. One earns from the advertisement and one earns from systematic and continuous solicitation. So they could be different people. Is there a link between explanation 3A and 2A? The answer is clearly yes, and that link is very difficult to understand. And I will reproduce the language here at the end of explanation 3A. It is provided that the provisions contained in this explanation shall also apply to income attributable to the transactions or activities referred to in explanation 2A. Now, I'm not sure what does it mean. The provisions contained in this explanation the provision contained in this explanation 3A is essentially a dimming fiction, which says that this income should be treated as from income from operations in India. Now, is this dimming fiction is thought to be inserted in explanation 2A, or it says that or it says something else. The doubt comes because when we look at the amendment which happens parallelly to explanation 1, is that the income which is attributable to SEP is excluded from explanation 1. Okay, so that's the first part. So now, next year onwards, and that amendment happens operational next year. Next year onwards, income related to SEP, okay, does not form part of explanation 1. It's kind of taken out of it. Obviously, the explanation 2A and 3A are made operational from different years. Okay, so that's kind of another issue. And so that still kind of keeps the question open, is that as to what is the reason for this proviso which they have added to explanation 3A. And then another question which we need to address is is this explanation 3A is supposed to have a retrospective effect, and that's for the reason that it starts with the word for removal of doubts. Well, they have used the word removal doubts, and they have also declared, whatever they have declared in the explanation 3A. The belief, the interpretation appears to be that this is not meant to be retrospective. Okay. When we look at the explanatory memorandum, it suggests that they are extending the source rule. The explanatory memorandum further says that they are amending the source rule. If they're extending and amending, then they cannot be clarifying, because it's not a clarifier in that sense. And on the top of it, the explanatory memorandum categorically says the date from which this becomes operational. Well, with that, let's some more time on the sub clauses or the main clauses of explanation 3A. Explanation 3A says that this operation shall include income from advertisement, which targets the customer who resides in India. The question is, what is income from advertisement? To begin with, one can start with two broad propositions. One is the income which the advertisement generates. Okay, and this is for the reason that when you read the OECD draft, not draft, they are the report, the final reports, they are saying that the technology is so sharp that they are able to identify from which ad what sort of income has been generated. Okay, because they are all talking about very targeted advertisements. And if you get driven by that, that means that you have an ability to probably measure to which from what advertisement you have generated what sort of income. And that may someone will want to rely on that to say that income from advertisement is to be seen as the output or outcome of the advertisement. And another interpretation could be that this is not income from sale of goods, but it is essentially the advertisement revenue. To my mind, the second interpretation is far superior and better approach. Because the BEPS reports, be it 2015 report or 2018 report, has a lot of focus on the advertisement revenue, and they've seen that as a major revenue earner or a business model which they are targeting. So, probably, it's reasonable to take a view that income from advertisement is essentially the income which the service provider gets, by making available the advertisement space or, or the related activities. We'll have some more issues on this, which we'll see in the, let's say, is an overlap, because you have explanation 2A with this, with 3A with this with advertisement, and you also have, section 165, the original, 2016 equalization levy, which also, deals with advertisement. I would say, well, I've tried to tabulate, this, but I don't intend to get into all of this in far more detail. There could be some overlap here and there, but essentially, what they've done is that they in section 1050, they've ensured that the overlap is addressed. So, it happens that both the provisions, would certainly not, be applicable at the same time. Now, with that, let's look at some of the issues around this provision. One, it says that such advertisement which targets a customer. Now, the question which comes up is that, who is a customer? Is a customer someone, with whom I already have some relationship? So if I own a Honda car, and if I, if the people who are kind of selling, servicing of Honda car, okay, that's a target advertisement to me because I'm already a Honda customer. Okay, and that's why they are targeting me. Or can I say that when the advertisement does not target an existing customer, but it targets a random people, that doesn't get triggered here. Probably that's not the interpretation. Certainly, it would have been far better had they used the word which targets person or targets people in India, or had they not used the word customer, the things would have been simpler. It's applicable, when the Indian resident access ad outside India, because they would use the word resides in India. This words are kind of discussed in the subsequent slides. It's applicable, when the non-resident who access the ads from within India, so the Indian protocol part of it, which gets triggered here. It's not clearly stated that this is applicable only for the internet advertisement. We can have a situation where the cricket match is played in Australia, and on the boundary lines, you'll have advertisement of Pan Parag or Pan Bar or whatever, to which only the Indian customers, or the only Indian viewers are addressed. So this kind of advertisement could also, may get included. Now, what is income from advertisement? Certainly there are advertisement is an industry. Okay, one advertisement which gets created. So we can think of different players. So one person could be a person who owns the website, who allows the person to put up his ad. Okay, at the same time there is someone who produces the ad. Okay, there is someone who could be a sub-producer who helps the person to produce the ad. So it's an industry, and there are various players and there are sub players. The question will come up as to what income is kind of targeted here. When you go back to 1995, there's a TDS on advertisement, and we have circular number 715, which gives some reference, but I'm not sure to what extent is relevant now. It's better that the government comes up with a clear solution to this. And again, the question is that is the entire income from advertisement subject to tax in India, or one is supposed to look at some sort of proportionality and see that only the operations which are performed in India get subject to tax in India. Well, we have some rules which are then the pipeline. Some rules will come up, and that's going to address the issue. So probably for the moment we don't have to think about it. Sale of data, probably I'll not spend a lot of time on the basic provisions. One word which I want to highlight is that it talks about data collected from a person. Now practically, what we mean by collected from a person, when the person cooperates and he gives data, that's where the data is collected. But a lot of the times, they collect data not from a person but from a machine, because that's how the systems are designed. And I'm not sure, whether someone can say that on this basis, the data is not said to be collected from a person. That's very technically a weak argument. Again, there could be a business model wherein a person, a non-resident does not necessarily approach any one person in India. So data is collected without involving any other person from India, and that's why one may be in a position to stay out of this. But this appear to be a little about theoretical arguments. Again, with the words, words which are used in clause 2, this issue which comes up is that, let's say there's a sale of data. So company A is kind of collecting data from India. So, this three individuals, myself, Nilesh, and Siddharth, we are three people. The data is collected by A Limited, and A Limited is selling data to Y Limited. The explanation is straight away applicable to it. Now, the data gets traded. Y sells it to Z, Z sells it to U. So there's a sale 2, sale 3. Now, the question which comes up is that, whether the explanation is applicable to sale 2 and sale 3. Okay, if I look at the language, it says sale of data collected from a person who resides in India. When Y is selling the data still remains data collected from a person in India. It doesn't change the character of a person. For Y, it's data purchased from from India. For Y, it's a data purchased from A Limited. But my view is that the intention is clearly not to target sale 2 and sale 3. Maybe they would want to stop, at the first transaction itself. Well, then we move on to the next next subclause, and it talks about sale of goods or services using data collected from a person who resides in India. Now, if one kind of tries to think and what can be done by an organization after collecting data, the organization may collect the data, purchase the data, generate the data, and sell it to someone else. Organization may collect the data, purchase the data, and use it for its internal functions. The organization may collect the data and use it for internal core functions or for improvising the products or designs. And I would feel that probably the provision is still not very clear, as to whether to what extent the two categories in between would get covered by this. Let's look at one more example. We have A Limited, which is collecting data from India, and there are 5 people. So the slide was created before the lockdown happened. So 144 was not violated. There was no social distancing applicable at that point of time. So the data was collected, and A Limited sells the data to B Limited, and B Limited kind of sells its product using that data. And the question which comes up is that does subclause 3 get attracted here? And when we look at the language, sale of goods or services using data collected from a person who resides in India. Now, it's the same issue. The data is collected from the people who are residing in India, but the data is not collected by B Limited. B Limited had purchased the data, and B Limited is using the data. So it deals with with the operations confined to purchase of goods in India, and this operations. I mean, these are essentially exclusions. This functions, this operations do not result in a taxable income in India. So you have purchase of goods, which does not result in taxable income. You for ad agencies and news agencies, the collection of news and views in India for transmission out of India, it does not result in taxable income. But when you collect data from India, that results in a taxable income. Obviously, the indices are different. The nuances are different, but so on the face of it, it may appear that there's some inconsistency, but not necessarily in all the categories. So when you look at purchase of goods, certainly when the data is when the goods are purchased, it does create some sort of income in India. But when the data is collected, in most cases the data is collected without probably creating any income, taxable income in India, and that's why even if there's inconsistency, probably that's so that kind of concludes my discussion on explanation 3A. Now we're left with 2 more topics. One is section 6, which was kind of partially discussed 2 days back. And then this equalization level is so I'll be a little faster on these 2 provisions. So before I get into this, Nilesh, any comments which you want to make at this stage? Am I going right, wrong, slow, fast?
Sorry. I was on mute, so my comments are that you are doing fine. You can continue, and by the time the end of the session, we'll get the questions. Even I've got a couple of them lined up in my mind, but I will ask them at the end.
Okay, fine. So I'll continue. Yeah. So when we look at section 6, what are the changes they've made? And the changes I've kind of clubbed in 3 categories. One is they are curtailing the benefit of explanation B, to certain Indian citizens and PIOs, with income more than 15 lakhs. And I've loosely used the term Indian income here. They have created a new category of deemed residency for Indian citizens, and PIOs are not here. With income more than 15 lakhs, so that's another category. And then these 2 categories, are also given a status of RNOR. So this is broadly the amendment to section 6, and we'll look at some part of it, some of the nuances in the subsequent slides. So when we look at this explanation, now they've defined the term income from foreign source. And that concept is is also used in a particular manner. So income from foreign source, basically, is a income which accrues or arises outside India. Again, this what does it mean itself? Could be a matter of question. When will you say the income accrues or arises outside India? But then what is very clear is that they do not want to include within that the income from business which is controlled from India. Okay, now the manner in which this particular expression is used is essentially saying that is Indian income. I'm not using the word Indian source income because that may have a different implication, but I'm loosely using the word Indian income. So net, if there's an Indian citizen which has an Indian income exceeding 15 lakhs, then for him these are the consequences. Now there is some sort of a loop or a circular reference which gets created because of the usage. We have a concept of total income, and for which is categorically defined, and you also have in section 5. Now to determine total income, you have to necessarily understand the residential status of a person. And now, because of the new provisions to determine the residential status, you also need to understanding about the total income. So it kind of creates a circular reference. Obviously this is a law, so we cannot use simultaneous equations. But there's something which the government will have to come up and clarify to make these provisions very clear and operational. In the memorandum, there is a reference to stateless persons. Now, my understanding of the term stateless is that people who do not have citizenship, who are not national of any other country. Now here, these provisions are categorically meant for Indian citizens. So I would say the stateless person concept or usage is not good, because we are categorically talking about Indian citizens here. And again, when we look at the provision, this provision is getting attracted even if the entire income is is an Indian source income. So let's think about a person who does not have any income outside India, okay, but has only Indian source income, okay, and he is a non-resident. But because of this provision, he would be treated as an Indian resident. So what are the conditions for deemed residency? He should be a resident of India, and there's no reference to PIO here. His total income, his total Indian income, exceeds 15 lakh rupees during the previous year, and he is not liable to tax in any other country by reason of his domicile or residence. Now, this word liable to tax is something which which created a lot of debate and discussions the day before yesterday. So I'll kind of keep lesser focus on that. But essentially, the words liable to tax in any other country or territory, these words are, I would say, are broadly lifted from Article 4.1, of the tax treaty. Very interestingly, they're not used, they're not made reference to tax residency in other country, but they prefer to copy these words from Article 4 of the tax treaties. What does this create? This creates that a person can be said to be a resident of India, without he being present in India even for a single day, and the status, is determined purely based on the level of income, on the amount of income. Interpretation of section 1A, 6.1A, basically the deemed residence concept, would certainly be, to my mind, dominated by tax treaties. Whether a person is a resident of another country, and or whether he's from a country where there's no tax treaty which is available, and if he is able to produce a TRC, okay, then that would probably would be a better defense to say that he's not applicable. Now, to understand the interplay, with the tax treaty and the treaty language, what I've done is that a kind of thought of dividing the treaties in 3 categories. Category 1, which has a standard language, of Article 4.1 of OECD or maybe the UN model, which talks about which makes a reference to liable to tax in other country. Okay, that's one category of income, one category of tax treaty. And if we have to interpret tax treaty, then the language of 6.1a, okay, will exactly tally with Article 4 in that tax treaty. So no problems are listed there. The problem comes for two reasons. Section 6.1a does not make any reference to tax residency in other country, but it says that if he is not liable to tax in other country by virtue of domicile, residence, etc. And then when we look at certain categories, category 2 and category 3 treaties. So if we look at UAE, in the context of UAE, it does not make a reference to liable to tax. It clearly makes a reference only to the number of days of presence in UAE. When we look at another set of treaties, which is India, Belgium, Australia, Italy, Namibia, Singapore. Okay, these treaties again do not use the standard language of Article 4, but they make a reference to the domestic law requirement. And then what they're saying is that if a person is a resident under the domestic law, okay, then he is to be treated as resident for the purpose of Article 4.1. The question which will come up is that in this kind of situations, when we are faced with this kind of a tax treaty, how do we apply Section 6.1? I would say to apply Section 6.1, I'll have to keep on reading and interpreting the word if he is not liable to tax in any other country or territory by reason of his domicile, residence, or any other criteria of similar nature. So for a UAE resident, okay, if a person is resident in UAE for 183 days, I have to address this question whether he's liable, not liable to in tax in UAE by virtue of this reason. Similarly, for Belgian resident, I have to address this question. I would say, well, although they have not used the word tax residency in other country, I don't know whether it's just a conscious decision on that part. But essentially, I would say the approach is to align the concept with the international law. When you have treaties which are signed, with different languages, you can't have a language, which refers to all the languages and all the tax treaties. But broadly, they have tried to do it. And the approach could be that, if a person is a tax resident of any other country, okay, then certainly explanation 1 is not thought to be, Section 6.1a is not thought to be affected. But you have this, difficulties will arise, when the language is different in this case. Now, now we talk about, a reverse situation. Now, assuming, the question to be here is that whether this deemed resident can claim benefit of an Indian tax treaty. So I'm talking about, take an example of a person, who is not a resident, of any other country, any other under any other treaty, and he becomes, Indian resident, Indian deemed resident by virtue of explanation Section 6.1a, and he's earning income, let's say from Russia. The question is whether he can claim benefit of India-Russia tax treaty. And that's where I would reproduce the definition of Section 4.1 in the India-Russia tax treaty. And I have to answer the question of whether this deemed resident, whether he is liable to tax in India by reason of his domicile, residence, place of management, or any other similar criterion. And I would say the answer to this question, would be no. I would say, that in this case, this person is not Indian tax resident for tax treaty purposes, for the reason that he is not liable to tax India on his global income. The concept of residency under a tax treaty is that a person is liable to tax on his global income. That's not the case in India. The deemed resident is not liable to tax India by reason of his domicile. He is liable to tax India for the reason that he is not resident elsewhere, okay, or any other country. And these are not the parameters, which are essentially to be applied for determining residency under domestic law in terms of Article 4.1. So in this case, for with treaty with a standard language of Article 4, I would say, a deemed resident, would not be in a position to claim treaty benefit. However, if we have a treaty worded differently, okay, then the answer could be different. So let's say in India-Singapore tax treaty, it makes a reference to a domestic law. So again, I think the key issue to be addressed here is that after doing all this, what was thought to be achieved, and what is actually achieved. Because at the end of it, by bringing in all this deeming concept, a person is first deemed to be a resident, and then he is deemed to be RNOR. All that it means is that a person is liable to tax only on certain categories of income by virtue of provision to section 5(1). And then the question is, what is achieved? Is there any incremental income which comes in tax net? I would say no, because the Indian source rule is very robust, and it's very tight. It would not probably let any income to escape in this kind of situation. So maybe there's no incremental income which comes to Indian tax net, but certainly the rate of tax could be an issue. Income which was subject to tax in the hands of the person, at a rate applicable to a foreign non-resident, would be taxed, at a rate which is applicable to a resident. So that to that extent, there would be some impact. A very interesting question which comes up on the next slide is that is section 6(1) a beneficial provision? How does it read? It says notwithstanding anything contained in clause 1. Okay, so it clearly kind of overrides subsection 1, clause 1 rather, and it declares a person to be a resident. And then the question is, can I use this to my benefit? Okay, I would say even if I am a resident in clause 1, I would say because of 1A, which overrides 1, I'm a deemed resident. And then I say I become a NOR, and then I say my entire global income is not subject to tax in India. It's only certain income which gets subject to tax in India. Well, technically, one may want to make this argument, but clearly that's not the not supposed to be the intention. Okay, that's not how this is meant to be applied. But someone may want to think on that direction. Well, there are two more points on this. One is I want to make a reference to section 6(5). This provision is there in the statute book for very long, which we have been using. But this comes from from an old era, which is not probably relevant now. It was relevant when the person had ability to select different assessment years, not necessarily 1st of April to 31st of March as the previous year. So it's something which remained here in the law. Probably they could have deleted for some point of time. And the last question is again not necessarily arising from this provision, that is there a scope for claiming non-discrimination article under the tax treaty for foreign citizens. So that completes the discussion on section 6, and then we are left with equalization levy. So Nilesh, how do we go about it? You tell me how much time should I spend on this, so accordingly I can decide.
Radha, can you hear me?
Yeah, I can. You have to unmute. You have to speak louder.
Yeah, I just did that. Basically, how much time will this take? Means if it is, if you think you will be able to cover it up within 10 minutes, then we can cover it and then open for the questions.
Nilesh, EL is is a provision on which one can take 1 hour to us. If we work in the reverse direction, you tell me how much time I should say. So then I will selectively pick up only small issues. Instead of doing the entire thing, because I'm also mindful of the fact that this has already been discussed in this webinars a couple of times in the very recent past.
So maybe you can take 10 to 15 minutes.
Okay, fine. So so then I'll devote 15 minutes. Okay, and then I'll stop, and then maybe as I said, very simple basic questions. If it comes, I'll be able to answer. Okay, so well, opening remarks. I would say. A lot of the discussion, which we may do, may turn out to be, kind of premature, because what has happened, what we realized in the last 10 days is that although this provision is kind of pushed in a very hurried manner. Okay, it came on 23rd of March, and I don't know how much time the government worked on it, before that. And when we had a discussion, with the government authorities in public forum, although in a private capacity, whatever you call it, but it seems that, there are several issues, which are open. Okay. And, it appears that maybe they have a different thing in the mind. Okay. So it's likely that, this may go a substantial change in the times to come. So, in that sense, some of this may turn out to be, theoretical, but, as it stands now, we'll have to analyze the provisions they're worded. Now, with that, let me first, as I said that, this potential change, at a future date, let me draw, attention of the group to, a particular section in the Finance Act 2016, in that section 180, which Mr. Varshney, in some indirect manner made a reference to. This section is, is very interesting. It authorizes the government to remove difficulties. Now, I have noted a comparable provision in the GST law, which is operational since 2017. And very interestingly, what the government is able to do is that by invoking this provision, okay, they directly make amendments to the GST law. So, you don't have to go to Parliament at a time of making amendment. You don't have to adopt an ordinance route. Okay, it's simply the government is authorized to make changes in the law itself, and the changes are made. Certainly, obviously in the GST law, a lot of the changes which they have made in this fashion, and initially when I saw the changes coming in, and I was really surprised in how these changes are happening now. How is that without Parliament getting involved, this this provision is getting amended, in between, the year. But the provision, gives them a power. But by and large, the power is utilized in the GST law for doing only procedural changes. The kind of changes, which are contemplated in the equalization levy. My reading would be that these are not necessarily consistent with the provision of the current provision of equalization levy, and there will be reasonable doubt, extent to which this can be invoked. So that will be one observation which I thought I'll make, because this is kind of a new provision for for the direct tax professionals. Another observation, is that, well, we have very little guidance, to interpret these provisions. Obviously, it got announced on 23rd of March, and it became operational 1st of April. So if you see the industry had about 8 days, to read and interpret this provision. There is no guidance in the explanatory memorandum to the finance bill because it was not done in February when it came, and then again in March when they announced, there is no guidance which they have come up with. So we have guidance in the form of OECD reports. We have guidance in the form of the committee of Indian Committee on e-commerce. When the equalization levy was inserted, and then we have guidance from explanatory memorandum from finance bill. Okay, a lot, and then we have a guidance from the interim report on digital economy. A lot can be read from this. Okay, but obviously, this is committee report. This is a kind of a 2016 working, and and Mr. Varshney has clearly said that a lot has changed between 2016 and 2020. So probably the way the provisions would come, would not necessarily be consistent or be driven by the theories which were kind of applied in that year. One issue which I want to talk about is the definition of online e-commerce supply and service. So that the definition of online, and which is little technical definition. Online means facility, service, or right or benefit or access. And these are the terms which one has to interpret. Then that is obtained through internet on any other mode of digital telecommunication. Now, to my mind, what we are doing is online because we are live at both the ends, and that is online to my mind. But then the way the discussions have happened, maybe even if attempt is made to say even in email, communication can be said to be online. So there, there are reasonable doubts about what is online. Again, in 2016, when the concept of online came, it was there in with reference to online advertisement. Now, in the current scenario, with the new set of terms, how do I read the word online? For the goods, in the context of goods, in the context of services. If I have to apply digital, this thing to digital goods, then it's fine. But if I have to apply it to physical goods, okay, which of these 4 terms, which of the 5 terms, do I use for physical goods? Have I obtained facility through internet? Have I obtained services through internet? Have I obtained right through internet? Okay, so these are the issues, which are coming up, in the context of, the new provisions which are uncertain now. Again, the things like services which cannot be availed online, like a hotel room, can it be said to be availed online? Now, a lot of these issues are very clearly, discussed and addressed in the 2016 report. Okay, but obviously the authorities are taking a view that that's a committee report, and that's not something which represents the government views. Interestingly, the direct tax law, the income tax act, is getting influenced more and more by the GST law. They use the word supply in this in this provision, which is kind of very prominent in the GST law. And again, they use the word supply of goods or services or both. Okay, again, the word or both is straight away lifted from the GST law. Some of the definitions, if you see the supply definition which are used in 194O and in this provisions as well, are bodily lifted from section 52 of the GST law. Okay, I will skip this. Okay, I think this understanding of the revenue streams is very important. Is that revenue streams which get generated from an online transaction would depend on the nature of transaction. You can have an operator who e-commerce operator who sells his own goods online. He could be selling his own product services online, or he could be facilitating the goods owned by a vendor. Especially when he facilitates the goods owned by a vendor. Okay, there are two transactions happening therein. One is the facilitation transaction. So the commission income is one source of income or one stream of revenue, and the second stream of revenue is a consideration of sale. Now depending on the way we interpret the provisions, okay, the issue which come up is that on what the levy is to be levied. So let's take a very simple example wherein a vendor is selling a product for 5 lakh rupees through internet, and the operator gets a commission of 25,000 rupees. And the question which comes up is that 2% levy is to be applied on what amount? Is it on 5 lakhs or it is 25,000? Okay, or which of the amounts? And then we have arguments in favor of both of this. The argument in favor of levy of 2% on this 5 lakh rupees is that if one gets influenced by 194O, the reason why 194O is kind of puts an obligation on the operator to do TDS is that he's the one who has the ability to control the funds. He has a control over the funds for which 194O requires him to deduct tax. And if he if this provision is kind of inserted with the same kind of intention, then the operator has a control over the full consideration of 5 lakh, and that could be the reason. Another reason could be that the literal reading of the of the provision 165A can also lead to this interpretation that the levy should be on 5 lakh. Another reason could be that when we look at the overall scheme of the act, okay, you have explanation 2A which requires some rules, you have explanation 3A which requires some rules. So those are kind of a work in progress. As against that, equalization levy at 2%, is kind of very quick fix, for the government to generate revenue. And for that reason as well, the government may want to, levy just 2% on the entire amount of 5 lakh rupees. And, conversely, we would have arguments, on the other side also. One may say that, optically it may appear that the operator is getting the amount of 5 lakh rupees, but that strictly is not receiving that amount. It's not his receipt. He has to pass on the consideration to the vendor. What he retains is only 25,000 rupees. Also, another situation could be that what could be the levy? The situation where the vendor collects the money directly from the customer, and the consideration is not routed through the operator. In that case, the operator will get commission of 25,000 rupees only, and the EL in that sense would be on 25,000 rupees. Very interestingly, if the operator has a P in India, okay, then the transaction is not subject to EL. And then if that is the case, then then even the vendor, goes out of the EL, because it says that when the operators are paying India, there's no EL required. That means the kind of exemption they have given, okay, that also gives an indication that there is no levy contemplated on the entire amount, 25,000 rupees. Now overlaps, probably are clear. Mismatch issue is understood. I just want to spend a couple of minutes on this, whether these results are contemplated. A situation where the non-resident vendor has a pay in India, okay, and EL is levied at 2% on the operator, and then would the vendor be allowed to claim Section 1050 benefit and say that even if there's a pay in India, the entire income is exempt from tax because 165A is applicable. Another situation where the vendor is resident in India, okay, what happens? Would the resident's income would be exempt from tax under Section 1050? And the third income is situations that where the income is in the nature of royalty or FTS, okay, is the intention to give up 10% rate and levy tax at only 2%. Well, then there's an inclusive definition of P, so probably that's an old issue, so I'll not spend time on it. There's an issue of effectively connected to P. Okay, that's going to create a good amount of issues on what situation you can see that this effectively connected, and we have a good amount of judicial precedents as well. So I think I'll stop Nilesh here, and yeah, so I think I'll stop with this.
Yeah, thanks, Radha. I think that was an excellent exposition on the various provisions relating to the Finance Act 2020 relating to international tax, and you have covered it with very good examples. Before we proceed further, will you be able to go through the chat box and look at the questions?
So I am searching the chat box. Maybe you can read out the question, you can ask me, no issues.
There's one question which is that whether the R.D. Agarwal's case for business connection still, is it a good law?
Well, I would say R.D. Agarwal is still a good law. Okay, we may keep on reading that judgment, time and again, and every time we read it, we will come up with a, with a new provision. But that is certainly a good law. The term business connection is not comprehensively defined, in Section 9. So yes, that's still a good law. The definition has been extended, by including, Section 9 has been extended. Explanations are added, but the term business connection, still remains open for interpretation.
There is another question which I think there were two examples which you gave relating to sale of data and sale of goods or services using that data.
Yeah.
And you seem to suggest that only the first tier where the transaction is directly connected to data being purchased from India will be covered. But why not the second tier or the third tier?
Well, I'm just going by, by the policy, what could be the policy behind this, and and what could be the, the intention, behind this. Because then the second guy and the third guy, are going to say that, we never collected the data from India, we only purchased from India. And then, India has been compensated once, the taxing rights has been, respected once on the first transaction itself. So, so that could be the reason. But, as I said, the language is so open, and, one may want to drag it, in a different direction.
Means if there is any subsequent profit on the same data, perhaps that would also be attributable to the.
Well, I would say, when I'm applying explanation, 3A, I'll apply it only on the first transaction.
Okay. Another question is, does the TPO have an authority to adjust matters relating to the profit attribution, or is it only the prerogative of the assessing officer?
Well, I would say the at least under the regime which prevailed till before this Finance Act, the officer has a right to determine only the arm's length pricing, and not the core issue of Section 911, And that's why when you look at the amendment to section 92 C, C and CB, okay, they categorically included the language to to make a specific reference to sign 911. If it was possible to use the existing language, they would have tried to fix it within the arm's length pricing, but they've not done it.
Can I take the next question? Hello. 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 Hello.
So Nilesh, you're saying something?
I just muted and unmuted again. There is another question for expression 3A.
Hello?
Will the data include process data or raw data?
Nilesh, if you can be a little louder, I can't hear you.
Whether the data for expression 3A will include the process data or the raw data?
Well, I mean, as I said, I did reproduce one of the definitions of data. The term data is not, defined in the Act. So I borrowed a definition of data from the Personal Data Protection Bill 2018. But that does not necessarily give answer. I would say the provision will apply to both, be it raw data or be it processed data. There's a lot more guidance available on data collection and the models around taxation of data, and also models around advertisement revenues in the BEPS report. It's not, I've not made a reference to all of them, but to be precisely to your answer, I would say both the data could be covered if they're collected from a personal resident in India.
In that case, perhaps, Radha, if the Indian, the first tier transaction is only for purchase of raw data, and after
Nilesh, I can't hear you, Nilesh. Okay, in the meantime, now I have found.
Can you hear?
Yeah, okay, fine, Nilesh, I can. Nilesh, you're on mute.
Okay.
Yeah.
Okay, so if you can read the questions, I need not read it out again, so to save time.
Yeah, so I think I'll see from wherever I can see.
Mm-hmm.
The question is anything achieved by amendment to section 61A? Because the person will still be RNOR and the scope is similar to. Is there anything really changed so much in the amendment? So it's a very genuine question. We spend a lot of time trying to understand this, and after all the exercise, and I prefer the word kasrat here. The scope of income which probably remains the same. There's no incremental income which probably will get captured because the person at the end of it still remains to be RNOR. But the rate at which this income may get taxed may differ, and in that sense something may be achieved. Well, there's a very interesting question, how the data localization will impact if when the data would be in India without exploiting it. Well, I'm not maybe adequately understood the question. We have one is a regulatory requirement of data localization, and the tax requirement are triggered. If the data is sold, or the data collected is sold or is utilized for sale of goods. So I would say both are operating parallelly. If the conditions of the Income Tax Act, or the equalization levy are satisfied, then the tax will be levied accordingly.
There is another question, whether the citizen will also include a OCI in reference to section 6.
No, this is again, a question which comes from a Citizenship Act, or maybe more from a regulatory aspect. So I would not want to, I don't want to give any comments on this.
Okay. There are some other repetitive questions which I am not looking at. Kush, you have any other questions?
So I had one question. The change to the explanation to 6 clause 1 is that someone who was earlier remaining in India between 120 days and 182 days, citizen or PIO, would be a non-resident, and they were remaining for such a period in India for 6-7 years or 8-9 years and being non-resident, and then for 1 or 2 years they were being in India for more than 182 days, but they were remaining RNOR. Now, because the threshold has made them a resident, although an RNOR, and their income may not be taxable, but the moment they cross 182 days after being RNOR for a few years in the past, they'll directly become ROR instead of being able to be RNOR for 2 years, after staying in India for 182 days or more.
So, Kush, what you're asking is, is essentially, kind of a consequential impact, of this amendment. Okay, so, someone who was earlier not treated as RNOR, is made a deemed resident, and then he is shifted to RNOR category. And then what you're saying is that, in the subsequent year, that categorization, would also have a further impact of shifting him to, a kind of a ordinary resident category. Those are the consequential implications of these provisions. So that will imply. That's how it will happen.
Are there any other questions, Kush?
So let me just check one second, sir.
So there's a question, meaning of tax, only income tax. I don't know from where this question is coming, is what context. But I'm not sure whether this question was raised in the context of, Chapter 7A of the Finance Act, Chapter 8 of Finance Act 2016, because the word tax is used there, and some people are trying to take an interpretation, saying that equalization levy should be treated as tax or non-tax. But I think, I would say in the context of Income Tax Act, the tax would mean income tax. In the context of Finance Act, the tax would mean equalization levy. Maybe this question could be in the context of treaty as well, because the treaty gives you a definition of taxes covered, and one of the slides cover it, and deals with this. I'll not spend time on that, but it says any taxes, similar taxes introduced at a subsequent stage, in place of or in substitution of the existing Income Tax Act. So in that case, there is probably a kind of a reason to argue that equalization levy can also be seen as a tax covered within the scope of the treaty as well. But the problem is that the door to access treaty benefit is in section 90 subsection 2. Okay, so even if one concludes authentically that yes, EL is to be treated as an identical and subsequent similar tax as compared to income tax, and that's why that is tax is covered. But there's no provision which is comparable to section 90 subsection 2 in the Finance Act 2016, through which one can claim TD benefit. So that's why the TD benefit becomes difficult or not possible.
Okay, Radha, I think that was a very elaborate discussion on the topic allotted, and I'm sure everybody has benefited out of the discussion. Your presentation also will be put up on the IFA website. And to conclude, can I request Kush to propose a very well-deserved vote of thanks?
Yes, sir. So I think I'm sure whoever participated has gained a lot of clarity on the concepts which were discussed. And I think I thank you so much, sir, on behalf of IFA and all the participants for such a concise and clear explanation of the amendments and changes, and also for taking the time to share your knowledge and inputs with us. I think now that the lockdown has been extended, probably we can have one more session of that 1 hour on equalization levy.
Okay,
Maybe
thank
in the
you.
future.
Thank you, Radha. It was good, and I'm sure people have benefited. And thanks again for agreeing at a short notice. And we look forward to cooperation with you from time to time.
Okay, thank you.